Alright, today's bank is Capital Federal Financial Incorporated. It has a ticker of CFFN. It's traded on the NASDAQ. It's headquartered in Kansas, and it also has locations in Missouri and Texas. It's about 51 branches, I believe. It's about a $10 billion bank. They're on that $10 billion threshold, so fairly average sized bank. It's got a market cap of about 832 million right now, so pretty average sized bank, at least for publicly traded community banks. And we see over the past year that it's had the typical trend that we see for most banks, sort of a up, down, and then year to date sort of decides whether it's going to go up or go down. Also, over the past week or so, we've had a really good run-up in bank stocks, which has been really great for our portfolios. And looking at the PE ratio, they have nothing here, so that leads me to believe there could possibly be negative earnings, which would be the reason they wouldn't have anything here. Pretty good dividend yield. If we go over to the statistics side, we can see a little bit more. So trailing PE is about 13. That's a little on the high side. We're usually looking for somewhere around 10 or so. So that's a little bit on the high side. The price to book is on the low side, so it's possibly pretty cheap for its net assets. We usually see something between 0.8, 1.05, something like that. So maybe a reasonably priced bank on the net assets, but not so much on the earnings. Let's see how the earnings stack up. Yeah, negative return on assets, negative return on equity. So maybe we're looking at a bank that is exhibiting losses currently. And, as we stated before, we don't buy banks that are not making a reasonable amount of money. But we can continue on and see what else they have going on. So let's dig into the balance sheet here. The formatting of this is a bit odd. Let me see if I can work with this and make it a little bit easier to read. Okay, so I slimmed it up and put it in the middle of things. Let's see if that works. We might have to spread it out a little bit. Some of the tables go out wide. Anyways, so looking at the balance sheet, you can see cash, and keep in mind that this bank this company has a year end of September, I believe. So we're looking at basically 6 months of financials, so 6 months income statement. And yeah, so half of their operating year is on March 31st. So we've got cash of 443 million. That's about an average amount, 4.5% of the assets. It's usually the range that we typically see in. Securities, 843, which is really on the low end. It's about 8%. So pretty low amount of securities on their balance sheet. And then we've got loans of about 7.9 billion gross, which is about 81% of the assets. So they're a little bit more allocated towards loans, because we typically see somewhere 70 to 75% for loans. So 7.9 puts them at 81%. And with the securities being a little bit lower allocation and the loans being a little bit higher allocation, we could suspect that perhaps there's a higher interest income, but also a little bit less liquidity. They've got less securities than some banks, and so that might dampen their liquidity. So we'll see once we get into the income statement. But as far as the deposits go, they don't split it out here. They do a little bit later in the footnotes or the MD&A. So I can kind of line it out. There's about 550 of non-interest-bearing deposits, and then the rest, about 5.6 billion, is the interest-bearing deposits. So that puts the non-interest-bearing deposits about 6% of the liabilities, and that's a really, really small amount. We would typically see something like 20 to 25% of the liabilities being non-interest-bearing, and that's of course where we would want most of the liabilities to be because they don't cost anything, right? But that's not the case with this bank. We're looking at essentially 91% of their liabilities are interest bearing, and that's a really, really high ratio. And that's not good for interest expense. It's going to make their interest expense be higher than most banks. They also seem to have a lot of debt. The borrowing's $2.3 billion, so it's very unusually high. About 27% of the liabilities. We would typically see something between 5 and 9% of their liabilities being debt, but here we have 27%. So debt is a higher cost of funding than the deposits, presumably. So, with the combination of not having a whole lot of non-interest bearing deposits, but also being a little more further allocated to debt than most banks, we might see a higher interest expense than most banks. So let's go down to the income statement and see if that's the case. So we're going to exclusively look at the 6 months. That gives us a longer time period. They've got about 185 million of interest income. That's about 4.04%. That is really, really low. I don't know if I've seen something that low lately. And it's principally due to the loans. The loans are only yielding about 3.85%, basically dividing the interest income from loans by the balance of loans on the balance sheet and annualizing it, multiplying it by 2, puts it at a yield below 4%, and that's just crazy. That's crazy low. But on the flip side, their securities are doing really well. They have about 4.41% yield, according to just dividing this by the balance on the income statement. And we did see that in the 8Ks when we were reading through them, is that they sold a pretty large portion of their securities, I think over $1 billion. And so perhaps by doing so, they're now able to reinvest it at higher yields, which was probably a good move. So now their securities are yielding more than their loans. That's just that's very, very unusual. And so they're more highly allocated toward loans, which are yielding less than the securities. So they've got a pretty low interest income relative to assets of about 185 million. That's 4%. So that's really, really low. And so then coming down to the interest expense, we've got about 104 million in interest expense. That's about 2.5% of the assets. 2.5% of the liabilities. So that's telling us how much the yield on the liabilities is. 2.5%, that's actually not too bad. I mean, it's a little bit on the high side relative to the past year, but if you've been following us, you've seen yields on the liabilities of sometimes in the 3.5, something like that lately. So 2.5 is not too bad. It's not as bad as I would have expected from having not so much non-interest bearing deposits and also having a high amount of debt. We can see that the debt yields about 38 million, which is about 3% yield, so relatively really cheap yield, 2.99%. And we would typically see something, especially if these are FHLB borrowings, probably above 4, at least 4.5. So they're maybe getting a pretty good deal on the borrowings. And as far as the deposits go, they're yielding about 2.15%, which is a little on the high side, but not that unusual to see lately. So, so the net interest income after that comes to about 81 million. That's 1.67%. And that's really, really low. About half of what we would typically see for most banks. We're usually looking for somewhere around 3% on the net interest income. So I think a lot of that comes from a really low yield on their assets. I mean, we had a 4% yield, and the yield typically right now is at least somewhere 5.5%, 6% we would normally see. So I wonder how much interest income they would have if they had normal average yields. So they've got about 9.3 billion of interest earning assets. So multiplying that by 5.5% puts them at about 500 million of interest income for the year. So dividing that by 2 puts them about 250. So that would give them an extra 75 million. And an extra 75 million would put them at about 150 million. And so 150 million of total assets. And annualized, so multiplying by 2, would put them at about 3.18% net interest margin, which would be about normal, right? So we could say like the lack of yield in the loans particularly is really dragging down their net interest income. So it'll be interesting to see why their loans are yielding such a low amount. But it's backwards than what I expected. The liabilities seem to be okay, reasonably yielding, but it's the assets that have the issue and the lack of profitability. But coming down into the non-interest income, we can see here there's a big loss in the securities, so that must be where we saw that they sold a large portion of their portfolio. We pulled this out of our calculations because it's maybe sort of a one-time thing, I hope. And so we want to see, well, how's the bank going to operate going forward and normally, right? So we take that out and that gives them a non-interest income of 9.10 million. So the 13 plus negative 13 plus 4, positive 9.10, and that's about 5% of their revenue, which is a really small amount. It's about half of what we would normally see for most banks. And that's interesting because, they've got insurance and stuff that would be ancillary services to give them some extra fee income. And usually for banks that have the insurance commissions and so on, they would, at least have an average amount of non-interest income. So, maybe the insurance company isn't as large as what we would see in the average bank. Anyway, so they've got a less non-interest income than what we would typically see, so that's unfortunate. And then the non-interest expense, 57 million, that is about 29%. So that's actually really, really cheap of non-interest expense. We would typically see somewhere in the 40%, right? And they've got 29%. So all that together, after income taxes, gets us about 16.3 of net income, and that's about 0.55% return on assets annualized, and that's a really, really small amount. It's about half of what we would typically see. We normally see somewhere between 0.8 and 1.04. So seeing 0.5% return on assets means the bank's about half as profitable as most banks. And that could potentially be okay if the market price of the bank made it to where we're still earning a pretty good yield on what we buy it for, right? But it turns out that if we would divide this 16.3 annualized, so multiply it by 2, it's about 32 million. If we compare that, actually I misspoke. We took out this 13 million, so that makes this actually be about 27 million, this figure here, once we take out the 13. But anyway, that's about 0.55% return on assets. And so even taking out this big loss, we still have a pretty low profitability bank. And comparing that to the market price gets us an earnings yield of about 6.5%, which is really, really low also. We would typically see somewhere between 9 and 11% of an earnings yield, and we would prefer at least something like that. So we see that they've got a pretty low profitability bank, plus the price on those earnings seems to be in a range that doesn't give us a very good return. 6.5%. We could definitely invest that elsewhere to earn 6.5%. something less risky and more liquid, right? Anyway, so I feel like the profitability and the price on those earnings might deter us from wanting to purchase the bank, but we can keep on moving forward and see what else is going on. It could be in a future year we look at it again and decide that things are looking a lot better, but I think this year, probably will have to pass. All right, so let's get down to the securities. We can see most of them are mortgage-backed securities, which is pretty common for most banks, and then some treasuries here, some GSEs. So really the only ones that are carrying some sort of risk are corporate bonds for $3.2 million, and that's not a whole lot not a large percentage of the securities. So I feel pretty good about the credit quality of the securities. As far as the interest rate risk goes, we'll have to look at that later on once we get into the MD&A and the call report and go down the timing of the repricings and such, because they put most of them down here in this mortgage-backed securities bucket, because the underlying loans within the mortgage-backed securities, they can prepay, right? So there's kind of no definitive maturity that you could estimate or expect out of this. So they pledged about a third of the securities. Here's where they talk about they sold some of the securities. So they sold about 1.3 billion, and so they had a loss of 13.3 million. That's a lot. So they had a pretty large securities portfolio before now, and it gave them a pretty big loss. But now the securities, it seems, that are on their balance sheet are yielding, at least 4 or something percent, which is fantastic. So now we're down into the loans. The loans represent, 81% of the balance sheet. So this is where we are most concerned. And principally, we were concerned with the yield. It seemed like the yield on the loans was only about 4%, which is a crazy low amount for the market environment currently. And so looking at this, that's what I suspected. Most of the loans are residential mortgages. And so about 82% of the loan portfolio is residential mortgages, which we can imagine in the recent past, there were 3%, 3.5% type residential mortgages that people could get. And so it looks like maybe this bank loaded up on them back then and now is trapped into them. And that's maybe why we've got such a low interest income in the income statement. And I've got a little bit of commercial real estate, but not near as much of residential real estate. So hopefully if they've got a lot into residential mortgages, maybe the credit quality is a little bit more robust than if it had all been in commercial type loans. So we can get down and see a little bit of that. So we have the classified loans here. This would be the ones that are substandard or doubtful, and those are the ones that have some identified weaknesses that would make it likely that they would not be paid back in full. So we can add all these up. For the residential mortgages, we've got 10.6 plus 7.2 plus 3.2. So that's not a whole lot as a percentage of the loans. It's about 21 million, and that's only 0.33% of that category of the loans, which is a really, really low amount. I mean, we would normally see 0.5 to 0.9% of residential mortgages being classified. So it seems like the loan portfolio has a little bit higher credit quality than what we would see for most banks, which is a benefit. If we added up the substandard for each loan category here, it comes to about 23 million, and that's about 0.29% of loans, which is a really, really low amount. I mean, we normally see something like 1.10 to 1.7%. So it's about a quarter or a fifth or a sixth of what we would normally see as classified loans for most banks. So it seems like the credit quality in the loan portfolio is really, really good. So let's see what they have to say about non-accruals, past dues. So they make the past due table a little bit difficult to easily gather the data. But if we added up all the past dues, that would be the 30 to 89 plus and the 90 plus in foreclosure. That gets us about 23.6 past due, 23.6 million. And that's really, really low. It's about 0.3%. So about half of what we would typically see for most banks. And so that's really good. There's not as much past due compared to most banks. Some charge-offs. All right, so non-accruals, more past dues. All right, so the non-accruals are 8.8, which is 0.11% of the loans, which is really, really low as well. And we normally see something around 0.3 to 0.5, so really, really low percentage, about a third or fourth or fifth of what we would normally see. And modifications are pretty low too, basically about 5 million for 1 quarter, I believe. Yeah, for half the year it's about 9.8 million, so that's pretty average, nothing too unusual. And then we've got an allowance of 24.6 million, which is great too, is because we saw that I believe the past dues were 23.6, so the reserve covers all the past dues. The non-accruals was only 8.8, so the reserve covers all the non-accruals, as well as the classifieds, which was 23.2. So I feel like the reserve that they have of 24 million is really conservative. I mean, most of the time for the classified loans, we would see a reserve that covers at least all the classified loans. And for past dues and non-accruals, we might see a reserve that covers double the non-accruals or double the past dues. And it's pretty much what we're seeing here. So I feel like the reserve is really conservative, and the loan portfolio itself seems to have pretty high quality because there's very low past dues, non-accruals, classifieds, etc. So that's fantastic credit quality there. So now we're getting into the borrowings. It looks like 2350 is FHLB advances. That's basically all of the borrowing. Yep, and most of it's at fixed rates and then some of it at variable rates. But it looks like maybe they have some derivatives in place to hedge against the risk, the variable rate risk, that's a great idea. That's fantastic. So it basically fixes the interest rates and protects them about increases to interest rates if these variable rate advances were to reprice at higher rates. So that's a great idea. Let's keep going. So fair value. We'll typically compare the carrying value, which is what's presented on the balance sheet, to the fair value, which would allow us to look at some pricing measures. You know, how is the bank priced relative to the fair value of its net assets, but also some capital adequacy considerations. Do they have enough common equity net assets at fair value relative to their assets? Sort of a common equity ratio, but at fair value, right? So they don't have any held to maturity securities, so there's not going to be an adjustment there. For loans, it looks like we've got about a $400 adjustment to take it down from 7.9 to 7.4 fair value, and that's about 43% of equity, which is a little bit on the high side, but it would make sense given that the yields on their loans are at such a low rate compared to the market then now the market has decreased the value of these loans because you would need the price on them to decrease further to get to the market rate, right? Anyway, so that reduces their net asset value equity by about 43%. And then they've got a few differences in the deposits and borrowings, but not a whole lot. That's pretty common. So if we were to compare the market price, which we saw the market cap is about $824 million for the bank, and the tangible fair value of the net assets is about $650 million. So the fair value of the assets minus the fair value of the liabilities and taking out any goodwill or intangibles puts us at about $650 million. So we would pay $824 million for the bank, right? Its market cap. And we would get about $650 million of assets. That's about 1.26 times, which is actually a really cheap price right now. Most banks that we've seen are somewhere between 1.5 to 2.5 times of the tangible fair value of their net assets. So really cheap price on the net assets of the bank. Now, taking into account from a capital adequacy standpoint, by taking the tangible fair value of the net assets, so the assets minus liabilities, and dividing it by the fair value of the assets, gets us a ratio of about 7%. And so that's a really good ratio as well. I mean, we typically, for most banks, would be somewhere between 5 and 7% with that ratio. So the bank is on the higher end of that. So that would lead us to think that perhaps the capital they have in place is adequate compared to most banks, and maybe a little bit more robust than most banks. So yeah, so it looks like the credit quality risk is good, and maybe the capital risk might be good as well. We've still got some stuff to look at throughout the footnotes and the MD&A, but yeah, so far so good. So down in the MD&A, we typically look at, I believe, 3 or 4 major things. We want to see what are the yields on the loans and securities currently. We also want to see what are the liquidity and capital risks, which they'll have their own section for that. And then what's the market interest rate risk that we should be concerned with as well. And there will be its own section for that as well. So this company provides a lot of information in its MD&A. So in an effort of time, we're going to pass by a lot of it. And they have a table down here that lists out all of the assets and liabilities, as well as the yields for those. It'll tell us a little bit more about how the loans are structured and the yields on the different types of securities. This is for 3 months, so I'm going to jump down to 6 months. They have a section for just 1 quarter, but they also have a section for the 6 months as well. Since we're looking at the 6 months, we can do it here. So here we go. This is a table we usually see in the MD&A where we can analyze the yields on different securities, see if securities and loans and debt deposits, compare it to that of other banks, and determine whether it's a reasonable amount. So the total loans receivable right now is earning about 3.8%. That's really, really low. And we can see it's because of the residential mortgages that we were talking about earlier. So most of their loan portfolios in residential mortgages, and they're earning 3.38%. And that's just crazy low. I mean, we see most banks currently, because they're more allocated toward commercial type loans, their loans might be yielding at least 5.5%, 6%, something like that. So this is really dragging them down. And I'd be really concerned too about them being long-term loans. Think 30-year fixed mortgage at 3.5%. would not have been that uncommon recently. So we'll see a little bit how that goes once we get into the interest rate repricing analysis. But yeah, we can see the securities are earning really good. So 4.39%. And that's an incredible yield on securities right now. So it might be principally due to their selling their portfolio so they could maybe earn a higher yield. So that was a good play. And on the liability side, everything looks fairly normal. I mean, we would have expected the yield on total deposits to be a little bit higher given that they don't have very many non-interest bearing deposits. But I think the reason it wasn't is because they're earning pretty reasonable or paying pretty reasonable yields on savings accounts, checking accounts, and money market. Yeah, I mean, right now we would usually see something over 2% for sure, 2.5%. So if you took kind of a weighted average of this, it might be around 1% that they're paying for their deposits, which is a really, really cheap rate right now. Time deposits are a little bit more in line with the market, but it seems like they can get pretty cheap deposits here, so that's fantastic. That at least helps them out a little bit to cover the lack of interest income that they get on the asset side. And so that gives them a net interest income or net interest margin of 1.76%, which is about half of what we normally see. Typically 3% is what we want, and this bank's not getting it. We can see return on average assets 0.34%. That's super low. Efficiency ratio 74.29. That's high. And with this, we want it to the lower the better. Typically, we'll see 60 to 65 percent efficiency ratio, but this is higher than that at 74. It's basically the expenses divided by the revenues with a few other variables in there, but essentially that. So yeah, so we've already beat that to death. It's a low profitability bank, mostly due to the interest income and the low yield on the loans. So let's keep going and get past some of this quarterly stuff. All right, so now we're in the liquidity and capital resources. So they speak a lot about their various policies. One of the things they keep mentioning throughout the financial statements is their leverage strategy. Apparently they occasionally they borrow a lot of money from the FHLB and they reinvest it into the Federal Reserve bank account, which earns interest with the hope of earning some kind of margin on that, and they call it their leverage strategy. And they close it out by the end of the quarter, according to what they say. So, at first I was thinking they have pretty large debt balance. What was it, 27% of their liabilities, but that's not due to the leverage strategy, I don't suppose, if they close it out by the end of the quarter. So, they know better than I do the inner workings and the risks and the profitability of that particular strategy. But I feel like it's at a minimum distracting them from growing their loan portfolio maybe, or investing in securities that yield a pretty good amount, right? And if they were to use their deposits and other funding to originate loans and make other investments, they could probably be making a pretty good net interest income and net income as a result. But I don't know if that strategy is distracting them, or and even reading the 8K, they tried to justify how their strategy makes the bank more profitable by saying that the net interest margin should be higher, but because they've are leveraged up this way, then it sort of reduces certain ratios that we as analysts rely on. But if we're going to compare their profitability to other banks. We need to use consistent, we can't normalize just them because they have this strategy that no one else does, right? And we saw how it puts their return on assets, and it's not necessarily that, it's definitely the residential mortgages that are keeping them down. But the SEC even suggested that, maybe you should possibly take the discussion of that out of this, and so they agreed to. Anyway, I feel like the strategy is distracting them perhaps when they should really be focusing on growing profitable loan portfolio. Like I said, they know more about their own bank than I do. So looking at some of the liquidity measures, we saw that they've got cash of about 450 million, which was it's a pretty good amount. It's the average amount. It's about 5% of the balance sheet. They also have securities that they can use for on-balance sheet liquidity. We typically, as well as other analysts and other banks, look at, how much are the unencumbered securities on the balance sheet, and those will be the ones that they haven't pledged. They've pledged about 33% of their securities, so that leaves on-balance sheet liquidity of about $1 billion, and that's about 16% of the deposits, and that's a pretty good amount. So that's pretty liquid. We would typically see somewhere between 13 and 18%. Of course, this bank is a little bit higher allocated toward debt, so perhaps they don't have as much deposits as you might see on the average bank. But as a percentage of deposits, it seems like it's a pretty good liquidity position. They also have the ability to borrow from the FHLB, and they have availability of a little over $2 billion, I believe, from our calculations and from what we read in the financials. And that puts them at basically if you add the on-balance sheet liquidity plus off-balance sheet liquidity, as well as they've pledged about $6 billion of their loans, so they have about 8 billion loans, right? So they've got about 3 billion that they could perhaps pledge as well. And so all that puts them at about a pretty average percent of deposits, about 78% from our calculations. And sometimes with this, it's hard to calculate it based on how things are described and the language that they use, but it's probably pretty close. So anyway, they've got basically an average amount of liquidity. They've got an average amount on the balance sheet, but also an average amount that they could pull down from other external sources like the FHLB or the Federal Reserve. So feel pretty good about the liquidity. If we were to look at the actual capital, we saw that if we convert everything to fair value, they've got a pretty good amount of fair value net assets relative to their assets. And I think it was about 7%, which is above what we would typically see for the average bank. And they probably show, so as far as regulatory capital goes, they are using the CBLR, which is essentially the leverage ratio that most banks use. I believe if they stay below $10 billion of assets, they can use the CBLR. The community bank leverage ratio, I believe that's correct, if they stay below 10 billion. Anyway, the company's ratio is about 10%, which is about average with most banks. It also puts them above the regulatory threshold that they're supposed to have. They also had a Tier 1 ratio of 16.3, which is fantastic. That's pretty high. And I think, and this is risk-based. So, risk-based. So, and I think it's mostly due to their having a lot of residential mortgages in their loan portfolio, because those basically get a 0% risk allocation. They're considered to be really low risk in the eyes of the regulators. So anyway, all that together, it seems like they have a really good capital position, really good liquidity as well, at least when we're comparing to the same amounts relative to other banks. And for more traditional measures, they've got about 10.5% common equity ratio, which is actually on the high side, as well as the tangible common equity ratio, and because they don't have, it seems like they don't have any goodwill or intangibles that I noticed. So that puts them well above most banks for capital adequacy measures. And so then we've got more of the quantitative risk measures, and we can see the repricing structure of the bank here. So they tell us how much of the assets reprice at what time periods relative to the liabilities. And we can see that they basically are very liability sensitive in the short term. So we've got about $1 billion reprices in the first year, difference between assets and liabilities, and then 333. And this makes sense if they have a lot of long-term residential mortgages on their balance sheet that don't necessarily reprice for a while. Meanwhile, he's got these CDs that reprice in the first year probably, and deposits that reprice relatively quickly. So it seems like they're very, very liability sensitive, which in this environment I think is really dangerous. So I think the interest rate risk is very, very high. And I can't figure this out. I feel like they've got it backwards. Like the positive 300, positive 200, positive 100 should be up here if they're really liability sensitive. And it doesn't really make sense to have negative starting at the top. And yeah, so I don't know if they accidentally did that backwards, or this is really that if interest rates go down, they make less net interest income. But they're showing here how liability sensitive they are. So I'm not sure if someone messed up this table or not, or maybe I misunderstand. Anyway, so fortunately we do our own calculations with this to see, and we look at the call report to see how much of the assets reprice. We basically build our own version of this using the call report to see how much of the securities loans reprice each year and how much of the deposits and debt reprice each year. And we're more looking at 1 year out because I want to make sure within the next year we're not all of a sudden going to get our net interest income squeezed, right? I think after a year they've got time to restructure things, get some swaps or whatever it is to protect themselves from various things. But 1 year out could be a risk. But anyway, so we see that the loan portfolio, basically half of the loans reprice at least 15 years from now, and that's unheard of. Very, very few banks would have so much of their loan portfolio in such a long-term maturity or repricing. I mean, that's just horribly risky. And we're seeing that now where they're getting squeezed in those low interest rate mortgages. So, and then if you were to, look a little more recent, the loans that reprice 5 years from now. So if you add in the ones after 15 years plus the ones that add 5 to 15, about 80% of their loans reprice at least 5 years from now. So we're basically locked into the current yields essentially for at least 5 years, and these yields are already really low compared to most banks. So yeah, horrible asset liability management in my opinion. And if you look at the deposit or the liability side of their balance sheet, about 80% of their deposits reprice in the next year, as well as about 35% of the debt. So what we have is a whole lot of loans, and about 67% of securities reprice at least 5 years from now too. So, but that's not that uncommon. That's pretty usual. But so we have most of the deposits, and at least a third of the debt, which we know was a lot of money on their on their balance sheet. They have a lot of debt compared to most banks, about 2.3 billion, something like that. So most of that reprices within the next year. So when it does, it's going to reprice at higher yields, and interest expense is going to have to go up, right? But on the asset side, 80% of their loans and probably about 80% of their securities reprice at least 5 years from now. And so it'll take 5 years before these loans and securities get to the yields of today's market, which are a little bit higher. So what's going to happen is the interest expense is going to increase, and the interest income is going to stay the same. So we're going to get squeezed, right? And it's what's happened over the past year, and that's what's going to continue happening. Yeah, ouch. And that's how they've ended up with such a low amount of profitability, return on assets. So let's see if there's anything else of interest. Looks like most everything is finished. They do have a lawsuit going on about overdraft fees, which is pretty common. I mean, we see this with several banks. It looks like it was dismissed with prejudice, but it was appealed, so could continue on for a while. But this isn't uncommon for several banks to have in place. I don't think they have a liability accrued. They might. Anyway, so they've got about $2 billion or $2 million that they can spend on shares, repurchasing shares. So that's about 320,000 shares at current market prices. And so 0.24%, so not a whole lot of share repurchases that would move the needle. Anyway, so we made it to the end. So let's summarize what we talked about and what our decision is. Looking at the profitability of the bank, we basically already concluded that their return on assets is about half of what a normal bank might be returning, and so that's not good. Even if we compared it to the market price, the stock price on those earnings, it only gets us about a 6.5% earnings yield, which is a really, really small amount. I mean, it would be okay if they had smaller earnings if the price of the stock was low enough to where we were earning a pretty good yield on what we paid for it, right? But that's not the case here. And so, as that is, it's probably a no-go anyway, because we would prefer to be making at least 9 to 11% earnings yield, and we wouldn't be able to do that at this market price. And so, there could be circumstances in each of the three risks that we look at where we could possibly conclude, hey, they might not be making good money now, but they could be at some point, and that might persuade us to maybe buy the bank. But in looking at the risk, I don't think that's the case either, because especially the interest rate risk, where we saw they're very, very liability sensitive. They're trapped into very long-term residential mortgages for at least 15 years and beyond at about 3.5% yield. Meanwhile, a lot of their liabilities are repricing within the next year at higher yields, so they're just going to continue getting squeezed between the earnings on their assets and the earnings on the liabilities. And that's just too big of a risk for us. And so the earnings of the bank are already pretty low compared to most banks, but that's going to make them even lower. Could even be like losses at some point. Although we did see losses this year, but we're not taking into account the securities sales. Anyways, they do have really good credit quality, which probably stems from having so much of residential mortgages, which perhaps have a little bit lower credit risk. And as far as the capital, they seem pretty well capitalized. They have a good amount of on-balance sheet liquidity, at least relative to their deposits, as well as the ability to borrow from the FHLB. So I feel like that they have a pretty good capital position, even when we converted everything to fair value and compared the net assets to the fair value of its assets, we saw that they've got a pretty good amount of equity relative to their assets, at least when compared to other banks. So, but all that together, the profitability is just not in a place where we would be comfortable buying the bank, and also the interest repricing risk, I feel like, is really going to put them in a bind. And currently their capital's good, but eventually getting squeezed like that could really put them in a bind with their capital. And it could be potentially why they've had to sell a lot of their securities lately, $1.3 billion portfolio. Not sure if that's the principal reason, but yeah. So either way, I think the price is too high to buy this bank given the earnings as well as the risk to its earnings that we talked about. So anyway, thanks for listening. Definitely let me know if I'm on the right track, if you agree or disagree, if there's anything I missed, and also, make sure to do your own research and analysis before you make any, investment decisions. This is basically just a thought process for me personally, and what we would do for our own clients' portfolios. And so, our situations could be very different from yours. So make sure that you do your own research before you make any decisions based on this. So anyway, thank you for listening. See you for the next one.